Hey everyone, welcome back to Yuri's Box. In this video I'm going to be talking about the dollar, yields and gold. If you like this kind of content, consider leaving a like and subscribing to the channel. And as usual, nothing in this video is financial advice. For those wondering, I will be making a video about today's non-farm payroll report. It will be in a separate video. In this video I really wanted to talk about, again, the dollar and yields and really what drives yields. And again, I found this comment under my my stablecoin video I made this week. And again, I think this is a fair counter across the board. I mean, personally, I am not a fan of BRICS simply because there's a lot of narrative around it. But if you go and look under the hood, you know, there isn't much substance behind it because there's continuous infighting. Each member says something that the other member doesn't like. Like you have India constantly battling against China. I mean, India and China are, you know, can hardly be considered allies, and so on and so forth. But again, these are just opinions, and everybody is entitled to their own opinion. So there's nothing much to say. I mean, it's a very fair rebuttal, in my opinion. What caught my attention is, again, this part here. The rate of increase in the USA's debt is much faster than the total market capitalization of other stablecoins, so it won't help to keep bond yields low. Now, again, I'm gonna kind of warp what Michael said here, and I know this isn't what you said. I recognize it. I'm just going to use it as the starting point for really an argument around what drives bond yields. Because one of the main arguments that really people use to justify, for example, in today's environment, higher yields is the fact that we're going to have, we have out of control spending. All right, fair enough. And future bond issuance will actually, so the supply of new bonds will actually crowd out demand, driving bond yields up. And this is a trend that is hard to stop. And this is the kind of nothing stops this train, as Lynn Alden likes to say many, many times. Ever since 2020, I mean, we've had politicians, you know, both on the Republican side and the Democrat side, you know, go to the, especially, latest, the outgoing presidency rather was a Democrat. So again, not me passing judgment or anything, but, you know, Biden and the Democratic Party probably went to the fiscal well one too many times, you know, during their 4 years in power. And again, why do I say that? Because of a 6% deficit. All right, you know, no science there. But again, the idea that supply of new bonds will drive, yields to go higher is a fairly common narrative. And it is one of the narratives behind, the major bearishness, again, looking on the long end of the curve. So 10-year and out, 10, 20, 30 year. Who is going to want to buy a 10-year bond at 4.3%? When you know there are shenanigans going on with the CPI, you know there's going to be a lot of, you know, fiscal spend, you know that Trump is going to come out with tax cuts, you know all of that. So why in the world would you buy a 10-year bond at 4.3%? If you know that the theory, at least, is that new bond issuance will drive yields up. And again, I know, Michael, this isn't what you said, but I'm kind of extrapolating and I'm using it as my own starting point for the video. And to challenge this prevailing narrative at this point, because it's, again, prevailing, I would like you to just do a simple mental exercise. Let's go back to 2007, all right? Our good old trusty 06-08 cycle, all right? In 2007, we had a $9 trillion national debt in the US, which was roughly 62, I think it was actually 63%. There you go. 63% of GDP, and the US deficit of 1.1%. All right. And the 10-year yield, which is the chart you have in front of your eyes right now, was roughly, around, the peak was at 5.2, the second peak was at 5.3, more or less. But let's imagine for a second that you took a time machine, you went on a time machine, and you went back to June 11th, 2007. And the only thing you knew is that, again, the prevailing narrative, if you issue tons and tons and tons of bonds, that'll drive the yield up. Because again, demand won't be able to keep up with the supply of bonds. And if you went back in time and you told someone, again, using this prevailing narrative, that in 18 years' time, the US national debt would be at 38, 39 trillion, 40 trillion, doubling in size compared to GDP to about, I think it's 122% today. And on top of that, we weren't happy with that alone. We actually had a 6.5%, nearly 7% deficit. What would you say, or rather, where would you think long-term bond yields would be? Would you say 5% if in June they're at 5%? If the theory is you're going to flood the market with debt, deficit spending out of control, and so you're going to have to flood the market with supply, the only rational answer to where will bond yields be in 18 years is, well, certainly above 5.2, maybe 9, maybe 10%. Because, again, if you assume that it's all a matter of supply, then again, if we're going to triple the size of the national debt, and we're going to go, 6 times, increase by sixfold the deficit. What else can you think but of a 10-year bond at 10%? I mean, it's only rational. But the reality is a little bit different. If you fast forward till today, rates are lower than they were in 07. All right. We never reached the peak that we reached in 07. All right. The highest we got was 5% at the end of 2023. That was, the peak in yields for the time being, of course. But again, drawing a parallel, to history, we are exactly where we were in 2007, 2006, 5, even 98, when the national debt was much, much lower. So again, I'm not really discounting the idea altogether. I do certainly think it plays it has a role to play. I mean, being supply, but I think it is much more shorter term than people perhaps appreciate. And I think that on the long end of the curve, meaning 10-year, 20, 30-year, there are other things at play, mainly growth and inflation expectations. And let's focus on basically the post-2008 till basically just before COVID, all right? Because it was in this time frame right here when we started going to the fiscal well quite a bit, all right? You saw, Medicare, a lot of things just getting rolled out. And this is actually when, we started to see the national debt move up and up and up and up. Then Trump comes along and he has his tax cuts, and that pushes even more debt. And while, you do have these occasional blips right here, the overall trend ever since 2008 for yields is down. And again, this is coming at a time where, issuance Bond issuance is just climbing, 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 climbing. All right. More debt, more debt, more debt, more debt. And again, why did we have, this stimulus on the fiscal side during the 2010s, and why did we have, monetary stimulus at the same time? Again, we spoke about this many, many times. Just look, for example, at say just inflation. All right, the 2010s are notoriously famous for, lo and behold, sluggish inflation. A lot of the measures that were taken during the 2010s were to spur inflation. You had central banks holding rates at zero, you had fiscal stimulus, and you also had GDP growth really be sluggish. And we talked about this many, many times. And the way, probably the best way to visualize this is, again, the good old quits rate. What the quits rate shows you, and again, what inflation, it all comes well together, in my opinion. You don't have a boom and bust cycle during the 2010s because you don't have a boom. You don't have the conditions that are required for a boom, meaning people overdoing it. And again, the way we've called the 2010s, call them like wherever you like them, however you like, silent depression, malaise. I think malaise is probably the best way to put it. Because again, during this time frame right here, we had low GDP, sluggish GDP, sluggish growth, and low inflation. All right, because again, just to draw, a parallel to today, if stock prices go up in today's terms, what people do, they get that money and they spend it. All right. During the 2010s, if people saw their stock portfolio go up, know what they did? Nothing. Basically, this is what history is telling us. They did nothing, absolutely nothing. They felt better about themselves. They said, I made a few bucks. Great. But what I'm not going to do is spend it, because if another 2008 comes around, I don't want to get caught with my pants down. All right. I'm going to get ready this time beforehand. And we talked about how, COVID has kind of broken really the US consumer out of this malaise and catapulted it to something that is potentially more akin to the 2008 cycle, where people overdo it on the upside. And again, they have to pay eventually on the downside. Going back to the 10-year yield, if you look at this price action right here, all right, post 2008 but really, this was an awful circle. But if you look from post 2008 till basically just before COVID, and you look at it through the lens of supply, meaning bond supply, and the issuance of debt over debt over debt, it doesn't really make sense. It doesn't compute. I mean, if the theory is supply is what drives yields, again, and I might be missing something here. All right, it might be way more complicated than I'm making it, but this is something I hear many, many times, and I hear people consider many, many different things, right? But the chart. And the chart tells us a very simple story. And that story becomes quite clear, again, if you look at, and correct myself, rather than looking at it through the lens of supply, look at the chart through the lens of growth and inflation expectations. What were inflation expectations overall during the 2010s? They were low, very low. Everything central banks, governments did, they did it to spur inflation. Because people weren't spending. They weren't doing anything. They were acting defensively, trying to get over really the 2008 trauma. All right. and this comes back to what I said about the Fed. It's not that the Fed had zero interest rates and we avoided a recession because they had zero interest rates. No, they were reacting to what they were seeing in the economy. Again, because the Fed is reactive, not proactive in history. And that's why we had zero interest rates, because there was no growth. There was no inflation. We were trying to, come on, let's have some fun. And everyone's like, nah, I don't feel like it. That was basically the 2010s. All right. So again, if you look at this price action through the lens of growth and inflation expectations, all of a sudden it makes a whole lot of sense. All right. And you can go back to, to the past. And I think this is the best way to look at things. And also why we had, yields collapse right here at a time where, it wasn't like everybody was sitting on their hands and saying, well, who knows? Let's see how COVID plays out. No. I mean, we had massive stimulus right here. Massive. All right. And in fact, as growth and inflation expectations, lo and behold, we slowly rise up. And so again, I'm open to suggestions. I'm open to discussion, right? As Michael commented, and again, you know this. If you leave a comment that is that has a well, if you have something to say, I'll consider it, of course, and I'll try my best to keep up with everyone. Again, I'll take the chance to say thank you to everyone that has been commenting on my videos. Good and bad, good and bad. I read everything. Because it's just feedback. So again, feedback is always better. Is always good. All right, especially bad feedback. So again, thank you to everyone, and let's tie this back to really something that is more recent. All right, I took a quick touch on gold. Gold has been struggling. All right. Now, as I say many times, this looks toppy to me. I've said it before. I'll say it again. But am I calling a top? Am I saying short it? Short it with everything you got? No, absolutely not. Just because something went up isn't a good enough of a reason to short something. All right. The only thing, and again, this is similar to Bitcoin. It's really the past. All right, that's what's really making me uneasy. And again, it also comes back, a lot of the the gold bugs say is that, again, nobody's going to buy bonds because of the supply. The supply. If I am correct in, and really me, it's not like I have it's my original thought. I marry the theory that, tariffs are a tax, and they're more likely to cause economic pain than inflation, also given where we are in the economic cycle, and where wage growth is likely to be, all right? But again, this is water under the bridge at this point. I can't help but be, I don't want to say bearish on gold, but not as constructive as, the biggest of bulls are currently, even at these high prices right here. And again, just to put things into context, what am I going to talk about? 2006, 2008, you guessed it. The type of move we saw back then was eerily similar. All right, we had the first significant move up, then basically nothing for a year and a half. And then the significant top, which actually, the top in gold came the week of Bear Stearns. If you look at today, that was really my Aussie half coming out. So, move up, sideways action for about a year and a half. Well, more than a year and a half, really. Again, regardless, a year sideways action, breakout to the significant top. Now, again, is this the top? I don't know. what is relevant, in my opinion, I'll say a few things about gold, and I probably said them before, but it's worthwhile saying them right now. Gold does very, very well against uncertainty. All right, you can't really say that gold is correlated to anything, and that's what makes it great. It isn't correlated to anything. It's in a league of its own. And gold goes up usually when things are kind of looking a bit iffy. All right, you don't know what it is. You don't know exactly what it is, but you're worried about something, so you buy gold. All right, and just as a heads up, this move right here. All right, so the equivalent of the last circle right here, meaning basically this move right here. Well, right here from February 2024. Do you remember? I remember this quite clearly. I don't know if you remember. If you do, good on you. Why did we have this breakout in gold? What was happening right here? You might say something financial or whatever. It was right here, through in the February, March, when Israel and Iran started basically throwing firecrackers at each other. All right, and you had, World War III, you had all of that good stuff really come around. And again, so that's again a practical example of what I'm talking about. When you have uncertainty, and to a certain extent, a stagflationary scare, really, where inflation is kind of acting up or really not cooperating, and growth is kind of looking a bit iffy. But once you get into a situation where you know, right? Like in 2008, what was going to come, all right? Once Bear Stearns collapsed, that was kind of the first major red flag. And again, at that point, many people probably just, we have oil at 150, that's going to be inflationary for sure. But eventually, as time went by, you knew what was going to bite you in the behind, and that was, economic pain. And in that environment, gold doesn't really offer much protection. Gold is protection against what you don't know. Once you know what you have in front of your eyes, you don't want that, all right? Then gold has done its job. And it usually becomes also a source of liquidity at that point because it has performed so well in the lead up. It is one of the major winners, so what do you do when you're forced with, forced liquidations and whatnot? You sell your winners, right? You rebalance to something else. And that leads me to, really the dollar and bond yields today. Again, I've talked about this. I won't spend too much time on the dollar, as I've talked extensively about it. So today we had the non-farm payroll report. I was arguing going into it that perhaps if we saw a softer number, we could see, a so-called news failure, meaning that even in the face of weaker economic data, we probably had some dollar strength. Now, we didn't get that, and we didn't even get dollar strength there. All right, if you really we got a news failure, but not the one I was looking for. All right. I still, however, am somewhat constructive on the dollar. I mean, I'm not calling for a bottom necessarily right here, but the way I see the narrative going, it's like, the rest of the world is paradise, heaven on earth, and the US is basically Mongolia at this point. Is there some truth to it? There's always truth in something, all right? There's always some truth in everything, all right? Again, I maintain my constructive outlook on the dollar for the time being, also because if you look back, this is something we've talked about many, many times in my All the Collapse of the Dollar series. Again, this isn't something new. We saw this, this correlation between lower dollar and higher yields in January of 2008 till the summer of 2008. Bear Stearns was right here. yields went up, not down. What followed that was a stronger dollar until the first weeks of September, lower yields. And in the worst part of the financial crisis, we had it again. We had lower dollar, higher yields. Don't believe me? Well, I was going to show you the chart, but I got disconnected. I'm kidding. If you don't believe me, we can go just take our time machine, go back. I'm going to have to scroll back, aren't I? Yep. Well, not that much. Good. Again, week of September 15th, 30-year bond, what is supposed to provide protection, found a way of going up 40 basis points, losing you 10%. Right? Was that pleasant? No. So again, usually when we see this kind of correlation, this evil correlation, if you will, between lower dollar and higher yields, sometime in the future, I'm not calling for it next week, I'm not calling for it for Monday or over the weekend, all right? But sometime in the future, you're likely, well, if history is an indication at the very least, you're likely to see the exact opposite. A stronger dollar and lower yields. And in the face of that, gold actually passes the baton to exactly bond yields. And that leads me back to our trusty 30-year bond chart. And I know this, I mean, look, is it frustrating to see, bonds continue to flirt with, going lower and then they actually go back up? I was listening to a talk. I really should write these things down. I was listening to an interview where they were I think it was actually Bob Elliott. Bob Elliott on Blockworks. He was talking about this, how bond yields are really self-defeating, right? Because bond yields, when they decline, they paint a completely different reality. And and if it doesn't match up with current conditions, well, it's wrong. So it moves back up, and it creates another set of another reality right here. And every move kind of seems self-defeating at some point. So again, it can be very, very frustrating. But again, what I reiterate many, many times, and I'll talk about this more in detail today in my non-farm payroll report, is that this will be a process. It won't be, if we're looking for the smoking gun, if we're looking for collapse, instant gratification, as again, even Neil Dutter, I just finished listening to his weekly roundup, put it, I think we'll just set ourselves up for disappointment. All right. I keep maintaining the stance that this will be a process. We won't get everything next week, next month. This will play out. And again, I think it's time I give my elaboration on what do I mean with this will be a process. I think it'll be kind of threefold. All right. Part 1, Part 2, and Part 3. And I think we're currently living in Part 1. See, first of all, we have to kind of take a step back and acknowledge the fact that at the very least, throughout this cycle, the bond market has been nothing more than a glorified stock market. All right, we continuously tout the bond market's predictive abilities, but so far, everything that the bond market has told us has been consistently wrong. All right, this move right here, I point this out many, many times. Why did we have this move right here up until July of 2023? It was right here when the bond market was saying, central banks, you're still hiking rates, but you know what? You're going to cause a recession because of that. And so you're going to have to cut. We didn't have a recession, right? Far from it, all right? Again, for clarity, I was one of the schmucks that actually bought into this, all right? So I know what I'm talking about. And again, the yields had to play catch up. Then after that, we had, we're going to get rate cuts. Hooray. We didn't get rate cuts. We're not going to get rate cuts. Inflation is going to be a problem. Growth is going to be a problem. Inflation's going to be a problem. Growth is going to be a problem. Inflation's going to... You see what I'm talking about. And as long as we're in this kind of environment, expect more of the same. And what am I talking about? Do we have negative payrolls? No. Do we have collapsing PMIs? Be it S&P, be it ISM, whatever. Do we have collapsing PMIs? We have negative, contracting PMIs, definitely. But are they collapsing? No. And as long as we are in an environment where there is a shadow of a doubt of where we are, bonds will continue to act exactly like this. And again, if you don't believe me, just look at 2006, 2008. This right here, in December of 2007, was when we saw the recession get declared. Now, granted, were we at that point closer to the highs? Not necessarily. I mean, we were, about 50 basis points, call it. Not 60 basis points off of the highs, which is a nice move. All right. But really, if you're buying the 30-year bond, this is the kind of move you want. All right. And as long as we're in an environment where we don't really know necessarily what it is that's going to bite us in the behind, is it inflation or is it growth? Growth or inflation? What is it? Where you don't really have anything that is smacking you in the face, telling you, it's me, I'm the boogeyman. All right. As long as we're not in that kind of environment, it will just be a lead up to whatever has to come. So that's kind of part one. And I think that's the kind of environment where we are now. Where it's not like everything is roses. I mean, I talk about this every time we read, an S&P PMI report, regional data. They all say the same thing from February. Everything is not too hot, right? But again, do we have the smoking gun? Do we have conclusive evidence that it's, that we're in depression, right? No, far from it for the time being. So I would keep that in mind. And that is really part one of the process. Part two of the process is if we get, again, continuous pressure on consumers, you continue to see the slowdown. And again, this isn't something necessarily new. We saw the quits rate kind of decline into the summer of 2024. We saw initial claims, and I know I've said this many times, initial jobless claims are very, very lagging. If you're waiting for initial claims to tell you where you are, you're probably going to be late. Regardless, last year we saw really more of the same. A bottom in January, and we actually peaked in the summer of 2024 at about 250K. This peak right here was, a lot of the hurricane, so we had a massive 260K jobless claims in September. But again, we also had that kind of a lead up last year. And I expect more of the same this year as, we move towards the summer. And again, I'm painting a picture of how a soft to hard landing would look like. I would imagine we get more or less what happened last year, really. We continue to see, say, non-farm payrolls kind of hang in there, like, we saw today as well. You've got to love COVID right here. You got to love it, Thank you for making me zoom in every time. Again, 2024, where are you? Right here, all right? Last year we had 108K. And as we moved towards the summer, it got progressively worse, all right? It wasn't looking too hot. And that, I think, will be part two of the process, where we actually get the hint, again, like last year during the summer, that maybe the fundamentals of the economy aren't that hot. All right. Are we in a recession right now? Are we in a depression? Again, no. Okay, no. We might be. Again, it might easily get, revised lower in a year's time. But, taking things at face value, this is where I think we'll be in this summer, if I had to imagine a soft to hard landing play out. So again, just to summarize, part 2 is basically last year plastered over this year, right? So you have payrolls not getting too hot over the summer. And this will be the first step lower in yields at that point. At that point, I expect yields, and at that point, if we don't have yields going lower, I won't say get concerned, but at the very least reflect. But I do believe my base case, anyway, is that in phase 2, meaning sometime during the summer, if we do get that kind of growth scare that we got last year, I expect us to be, again, probably somewhere around here, maybe a little bit higher due to the fact that maybe the CPI is misbehaving a bit. Regardless, somewhere between 4 and 4.35. All right. Now, this is part A of part 2. Part 2B is if things actually get worse. And how could they get worse? Well, think about last year, and something that I've talked about many, many times. I've always been I've taken the contrarian view that what we saw from September to January wasn't really structural. We had a lot of transitory events that made the economy look better than it potentially was. Well, what if we don't get that this time? What if we get weakening job numbers during the summer? All right. And again, this is just me painting a possible, say, hardish landing. All right. What if we get weak numbers during the summer? But what makes the difference this time is we realize that we lack all of those transitory events that we had last year that made, the economy had to fall back on. So we get weak payrolls in the summer, and then from September to January, it just, the fact that you don't really have something to fall back on is just, at that point, you might get to see the weakness that you're looking for, and perhaps you might get to see negative payrolls from September to January. Again, this is also, stimulus notwithstanding. Again, that is what I'm trying to say. If during this time you get some kind of COVID stimulus check, again, it goes back to that growth and inflation expectations. If you get at this point, Trump comes out and he says, you know what we're doing? Doge dividends. All right. You know what we're doing? $2,000 to every person with 2 eyeballs. All right. that kind of stuff that will drive inflation up, and it'll drive inflation expectations up, driving bond yields higher. All right. And just to have a quick segue here, just to drive the point home. You can also look at what happened in October 22 in Great Britain. This bond move is basically what kicked Liz Truss out of office. And what did Liz Truss try to do? A massive budget where they wanted to do a massive tax cut. And if you take the perspective of, it's the supply of new bonds that got her kicked out. Well, what do tax cuts do? Massive tax cuts do at a time where you're battling with inflation. You're going to drive inflation expectations through the roof, which is exactly what we saw, and that's what got her kicked out, basically. All right. So again, just to reiterate, going back to West Virginia here. So part A is during the summer we get weakish payroll numbers, weekish to week, and actually through the September through January we don't have anything to fall back on, and so that's when we actually start to get negative payrolls. And in the face of negative payrolls, negative payrolls, you get inflation just tanking because you don't have an economy anymore. And again, this is where you kind of twisted my arm here, but where I would put the target, and this is the magenta box right here, the purple box here. What is it for? This is kind of where I think eventually the 30-year bond will go. Eventually, if we do get some kind of a hard landing, I think the top or the bottom end yields will be somewhere between 2.5 to 3.25, somewhere in that range. I don't expect us to be back below here, and I'll explain why in a minute, in just a moment. Why do I say 250 on the 30-year? Well, this is where I bring out the squigglies, all right, and kind of me looking at a chart. Funnily enough, the reason why I say 250 and 135 on TLT is because that is exactly where, the neckline, if you will, of this head and shoulders formation that we had during COVID, right here, shoulder 1, head, shoulder 2, 135 and 2.5, more or less, is the neckline of TLT, right? The neckline of the head and shoulders formation that we had on TLT. And historically, it is also, a place where TLT likes to top, all right? More around that price range, more or less. And again, usually, when looking in technical analysis thing, a retrace back to the neckline is, well, not expected, but it isn't out of the ordinary, all right? So that is 2.5. And this leads me to phase 3 of the supposed hard landing. Why wouldn't we get a double bottom? Why wouldn't we get the 30-year bond to, 0.75%? Because of what I said at the beginning of the video. Growth and inflation expectations. If we were to get around, if we were to find ourselves in 8 months, 12 months, in a position where the 30 years at 2.5%, you can bet your ass that growth and inflation expectations have taken a tumble. And in the face of that, it's hard to believe, or I find it hard to believe, that governments, central banks would just stand there twiddling their thumbs waiting for, worried about inflation. Realistically, everybody would be panicking. Everybody would be screaming for stimulus. And I think that is exactly what we would get. We would get, I'm just, for the sake of example, zero interest rate policy returns. We get massive QE. We may get massive tax cuts. We get, government trying to help a lot of people stay afloat, trying to help businesses stay afloat. Basically, some kind of a COVID 2.0, all right? And what will that do to the long end of the curve? Drive growth and inflation expectations up. And that will stop, in my opinion, the 30-year from dropping below. And again, it could happen, it could not happen. This is just, to be a speculation. But if I had to imagine the way it would go, I would say us being at 2.5% will represent the bottom, precisely because everybody will be reacting to the weakness via QE, tax cuts, and all that good stuff, propping up growth and inflation expectations, effectively basically making a higher low on the 30-year bond. Now, I don't know what the future holds for the 30-year bond. I do honestly. I have a hard time believing that this is where we're going back to. I am quite sympathetic. There is a part of me that is sympathetic to, say, what Jim Bianco says, for example, that this is the beginning of a bear market for bonds. However, simply because, not because of issuance, not because of supply, mainly because we are going, probably, I mean, unless, everybody just, grabs hands and, sings Kumbaya by the campfire, we get the hint that we're in a world that is less stable than this, all right? Where the US isn't really, the police of the world, and where you have other actors that have other interests. Russia, Ukraine is a great example. China doing its shenanigans in the South China Sea, with, basically poking Philippines and Singapore and Korea and Japan, whoever, every one of its neighbors, even if it's not in the South China Sea. All right. So I am quite sympathetic to the idea that we might be at the very least, out of this kind of bull market. But again, that is definitely way out there. All right. So I think we still have to deal with, the fundamentals of the economy. And again, that is how I would see the 30-year playing out. I don't expect this to be a revisit of the lows right here. Again, could this just be a massive double bottom? All right. And the chart is full of it, full of double bottoms on yields. I mean, just look at it here. 2012, later 2015, 2016, 2016, 2019, back here, 1998, 2001. And it's full of actually yields going back to where they were. Could it be? Who knows? Maybe. I try to keep my expectations in line, and just thinking that, we might get, at best, 135 on TLT in the case of a hard landing. I feel comfortable, basically with saying that is my way of, keeping my expectations in line. And again, if we were to see, a revisit of this low right here, I mean, it would be nothing good, all right? I mean, yeah, it might pump your bags in the meantime, but, you're probably not thinking about bonds and stocks at that point. I mean, you're thinking about other things, just like you were during COVID. So, again, that pretty much does it for the video. Again, I'm not totally against the idea that supply doesn't have a role to play, because again, it's like, imagine you're eating ice cream. I'll make the stupidest example I can come up with, because I just finished eating ice cream. Right? I was eating Haagen-Dazs ice cream. I'm eating my ice cream. Then somebody comes along and he dumps 50 buckets of ice cream. What am I going to do with 50 buckets of ice cream? All right, I get it. I get the appeal of the idea, but I just think that looking at the long end of the curve via the lens of growth and inflation expectations is just a better way to really rationalize what's been going on. All right. And again, I'm open to suggestions. I'm open to discussions. Again, thank you to Michael for the comment. It was, again, I don't necessarily agree with anything he said, but again, everybody's entitled to their opinion. I'm not here to convince anyone. Far from it. I'm just here to point things out and squiggle on a chart. If you enjoy this kind of content, consider leaving a like and subscribing to the channel. And I'll see you next time. Bye.